Hello and welcome back to the second part of the lecture on renewable energy markets, trading risks and strategies. We will now take a more specific look at the impact of renewables on market prices and what it means for investors, project developers and utilities that develop and manage a renewable energy plant, like for example a large photovoltaic solar plant or an offshore wind farm. As already explained, electricity is traded in several sequential forward markets. The most liquid one is the day-ahead market, where power is traded in hourly blocks for the next day. Let's explore some recent market developments in these markets. The graph on this slide shows the day-ahead market price, which is traded in hourly products for Dutch electricity from the 23rd of July to the 29th of July, the latter being the day traded on the day-ahead market when I was preparing this slide deck. First, we see an extreme large price range only in the matter of a week, where the price was 130 euros per megawatt hour at 11 p.m. on the 24th of July. The price is even negative for some hours on the last day. Note that negative prices have occurred more frequently in recent years. A negative price means that the power producer is willing to pay money to offtake the production. Obviously, this can only happen in times of excess generation, where it is too costly to curtail or stop a power generation unit. Currently, subsidized renewables are the main factor behind these negative prices. They have little to no incentive to curtail their production, as they may, for example, receive fixed subsidies per generated unit of electricity. If we compare the generation of renewables on these two specific moments in time on the website energieopwek.nl, we indeed find that there was very little renewable generation in the evening of the 24th, but a tenfold of renewable generation occurred on the 29th. Some of you may remember that July was a rather rainy month in the Netherlands. When traders then did not foresee that a day suddenly turns out to be a quite sunny and windy day in the middle of a rainy week, cheap subsidized renewable entered the market, while other power assets were already scheduled to produce. As a result, negative prices can easily occur. Note that the effect of renewables is not one-on-one related to the price, as power prices depend on many other factors like underlying commodity prices, plant availabilities, strategic bidding behavior, and carbon prices. Next to the day-ahead market, let's focus whether we also can find such effects on the real-time imbalance market. For that, let's take a look at what happened in Belgium during a hefty storm in the spring of this year. The figure shows the predicted wind generation forecast on May the 20th by the Belgian transmission system operator. The most recent forecast is the forecast portrayed by the green line. The actual measured wind generation is shown by the orange line. Note that around 10 p.m. there was a significant drop between what was predicted and what was actually realized. Now let's also take a look at what that means in terms of imbalances and prices in real time. This graph shows in purple the volume imbalances in Belgium for the same period, so that are the volumes. The red line in the upper part of the graph shows the real-time imbalance price, whereas the less visible brown line shows the day-ahead market price. Where the average day-ahead market price was 77 euro, the price during the drop in wind speed at 10 p.m. increased to more than 600 euros per megawatt hour. Note that prices actually also went as low as 11 euros. Such jumps are not unusual anymore, and as the spread between prices increases through the push of renewables, you may understand that business cases for flexible power unit, for example batteries, become increasingly interesting. Such increased power price volatilities and uncertainties make a renewable wind farm or solar plant often a challenging case. On the left-hand side, you can see a prediction toward 2050 of the capture price for specific technologies compared to the baseload price. Note that the baseload price is the average price over a year, where the capture price is the price a certain technology can expect to receive for its generation. One can see that renewable capture values are expected to decrease and remain well below the baseload price. The most important factor contributing to this difference is the profile cost. Profile cost exists due to a timing of production effect and is calculated by taking the volumetric weighted average. For example, when the production of renewables is high, the power price is typically lower as more low marginal cost producers enter the supply stack, and thus a renewable producer may capture a lower price for its generation than the average baseload price during a specific period. Renewable energy developers are as such eating in their own revenues, and therefore the profile effect is also called the cannibalization effect. Next to timing, geographical cannibalization may also occur. Further, imbalance costs, which are basically costs for prediction errors, also portray a large chunk of the difference between capture rates and baseload prices. Lastly, costs like liquidity costs arising from market illiquidity and other costs challenge the renewable business case. Next to costs, all these renewable price components also entail risks, as for example profile and imbalance costs are hard to predict upfront and entail therefore a large risk for investors when a business case reaches final investment decision. As such, it is important for renewable producers and off-takers to agree how risk and costs are shared at the time of contractual agreement. This is typically defined in a renewable PPA, which stands for Power Purchase Agreement. On this slide, there are three possible PPA structures. One where the producer is exposed to merchant risk, selling everything on the spot market, and being exposed to all risk associated with the renewable power plant. One where the producer sells his power at a fixed price. For example, pay-as-produced contracts guarantee the off-taker to pay a fixed price per unit of power produced. Volume may, however, still vary, and volume risk is thus only partly hedged, while price risk lay entirely with the off-taker in this case. The last PPA shown is one where the producer sells baseload, or a fixed volume. In this case, the volume risk remains entirely with him, but price risk is hedged. In order to compare the PPAs, understanding the value at risk concept is important. This graph on the right shows an example of a simulation on the revenue payout of a renewable project. The dashed line shows the expected mean revenue, whereas the dotted line shows revenue with 95% certainty. As you can see, open market is the most interesting case, however, also the most risky one, and thus not necessarily the preferred option. As the share of renewables and associated market uncertainties increase, such data analytics and market insights become increasingly important to understand and manage these risks. Risk exposures for renewable market agents are therefore changing quickly. With that, I would like to conclude this lecture on renewable energy market risk. Some key takeaways to remember are that energy is traded in sequential markets, the increasing share of intermittent renewable production typically drives trading closer to real time, and renewable capture values determined by costs like renewable profile and imbalance costs are important factors in a renewable power business case. Lastly, power purchase agreements are a way for renewable project developers, investors and off-takers to deal with these renewable costs and associated market risks. Thank you for your attention and feel free to reach out via email in case you have any further questions or are interested to discuss further. Thank you.